The top business stories live from the Sky News City studio. Energy prices hit their lowest level since Russia's invasion of Ukraine 2 years ago. Consumer confidence in the UK fell this month for the first time in 4 months. And shares of Standard Chartered surge on strong results. The Chief Executive, Bill Winters, will be joining me live in the studio. Good morning, this is Business Live with me, Ian King. Household energy bills are to fall in April following a reduction in the price cap set by the regulator Ofgem. The reduction follows a fall in wholesale gas prices. Well, Ofgem confirmed this morning the cap will fall by 12.3%, taking the annual bill for a typical household from £1,928 at present to £1,690, a decline of £238. Our business correspondent Paul Kelso is with me now. Paul, obviously good news in terms of inflation too.
Yeah, good news for consumers in the first instance and inflation. We can see quite why that is the case. I think it's worth taking a look at how the price cap has risen and fallen over the last few years. We've got a chart here that can set it out for us briefly. You can see on the left of the screen that pre-Ukraine war average, around £1,000, the average annual price. That seems a long time ago. Those skyscrapers in the middle of the chart, they're up above £4,000. Of course, the government was paying everything above £2,500 for households. That's the energy price guarantee. Worth drawing your attention to the red bars at the very right-hand end. The last blue one is today's number. Look, in June, the forecast is we could be paying less than £1,500. That fall in energy prices, as you rightly say, Ian, has helped bring down inflation, although we've had the best of that. The Bank of England won't be rushing to cut on the basis of these numbers. And I think a couple of things now to look out for as we return to a new normal of prices, still higher at around £1,500, £1,600 as it is today, still higher than it was. We might see potentially the return of a functionally competitive market for consumers. Already a couple of deals out there that might make it worthwhile looking at switching. So the last 2 years, the cap has effectively been the maximum. Everyone's charged it. There hasn't been a competitive market for consumers. The other thing is to look at quite what happens to supply and demand, crucially. Overall demand for gas in the UK is right in 2023 is about 18% down on the pre-war average. Industrial demand up to 50% down. That's partly because of a very mild winter. We shouldn't let that fool us. We can't rely on the weather to keep prices down, but we've diversified. We're now taking more of our gas from pipelines from Norway and liquid natural gas imported from Australia, the US, Qatar, on the face of it, more friendly countries to do business with. But we're still reliant in Britain on the kindness of strangers for our energy. So we got the excuse now to push towards renewables, but that transition has got more expensive. Money, like power, has got more expensive, so that has slowed down a little too. So the UK is benefiting from a more benign gas market, more benign weather. Whether it will last, and this is the new normal for prices, well, it's not just consumers who are hoping that is the case.
OK, thanks, Paul. Other business news stories for you now. And consumer confidence in the UK fell this month for the first time in 4 months, according to a closely followed survey published today. The Consumer Confidence Index, published by the data analytics and market research company GfK, fell by 2 points to -21 in February, with 4 measures down on January and 1 unchanged. But GfK pointed out that optimism among individuals for their personal financial situation for the next 12 months had not slipped back. It regards that measure as key to understanding the financial mood of the nation, because confident householders are seen as more likely to spend. Germany's economy contracted by 0.3% during the final 3 months of last year, according to the country's statistics office. The main areas of weakness were investment in the construction sector and investment by businesses in machinery and equipment, which offset a modest rise in both household and government consumption. The statistics office also confirmed that German GDP contracted by 0.3% for the whole of 2023. And the husband of a former BP employee has pleaded guilty to insider dealing after hearing his wife discuss the oil major's planned acquisition of a truck stock operator. Houston Federal Court heard that Tyler Loudon bought 46,450 shares in Travel Centers of America over a 1.5-month period ahead of its $1.3 billion takeover by BP in February last year. The company's share price rose by 71% when the takeover was announced. Loudon is now facing up to 5 years in prison and a $250,000 fine at his sentencing in May. He's already agreed to forfeit $1.76 million worth of illegal proceeds. And I understand his wife's filed for divorce as well. Shares of Standard Chartered have surged by more than 7% this morning after the FTSE 100 lender reported a full-year pre-tax profit of $5.1 billion for 2023, up 19% on 2022. Stanchart, which derives the vast majority of its income from Asia, Africa and the Middle East, benefited from an improvement in net interest income. That's the difference between what it pays depositors and charges borrowers, a rise in customer deposits and a reduction in credit impairments. It's raised the full-year dividend by 50% and announced a new $1 billion share buyback. And I'm very pleased to say joining me now is Bill Winters, the Chief Executive of Standard Chartered. Bill, welcome to you. You've raised your target for return on tangible equity from 10% last year to 12% by 2026. How much of a headwind are falling interest rates going to be for that?
I mean, falling interest rates is one of the things that we're going to have to overcome. But thankfully, we've got a lot of other things that are going for us. NII, net interest income, is about half of what our bank earns in terms of our top line. The other half is fees and services for things that we do, which is growing very, very nicely. But even the net interest income, we think we can grow despite falling interest rates because, the last few years, we've been optimizing a lot of what we do in the bank, which means we've been shrinking parts of our asset base. And we've done a pretty good job of that. So we've improved our returns from under 2% to over 7% during that time. I won't say done, because you always optimize. You keep on going. But we're not going to be shrinking the way that we were. We are going to be growing on the other side, which we have been. So on balance, we think we can offset the fall in interest rates and put some good numbers up.
Some people might question whether you're not being a bit more ambitious in terms of what you're targeting, given that HSBC, which is a pretty close peer of yours, is currently at mid-teens.
Yeah, no, we've got a long way to go to close the gap, not just to HSBC, but to others. We were at about 0% return 6 years ago. We're at 10% today. We've been growing. You can do the math, sort of 1 and a bit percent of returns every year. We've done it by having much lower loan impairments, loan loss reserves, which is another way of saying we've been cautious about how we've grown the business back from a pretty tough place to really a pretty good place today. And we're going to keep on going. So I think we've got a long way to go before we can deliver what we ultimately think we can deliver, but we're on the right track.
Some people will be quite surprised that impairments have come down, given the sort of drip of bad news coming out of the Chinese real estate sector.
Yeah. Well, we did take some losses in Chinese real estate. We took a bit in 2023. We took more, actually, in 2022. And it's been really the only problem area in our portfolio. So, but our aggregate credit losses are a little bit, around half of what we think is normal through the cycle. And it's because we really haven't lost any money anywhere else. Of course, the challenges aren't just China. I mean, we operate across sub-Saharan Africa, South Asia. There, countries have been defaulting on the back of the high interest rate, strong dollar, post-COVID environment. But, these countries are super resilient. And we've been in many of these markets for over 100 years, 160 years in some cases. Our job is to help see them through that. And, when we do that, we actually make some pretty good money. And that's where we are now in these markets.
I know you're a regular visitor to China. What are you seeing on the ground over there right now?
Yeah, China is almost a tale of two cities. In fact, it is a tale of two cities. So if you go to the old industrial heartland, or anywhere where property development has been at the center of the economic growth, it feels pretty bleak, right? So you got a contracting property economy, and property was close to a quarter of the overall output of the country. It's probably got a little bit further to go, but it's kind of stabilized, but now at a lower level. If you go to where the technology is being built, where services are being delivered, if you talk to the consumer, things look very, very bright. So the combination of the two has netted out to 5% growth last year. We think probably about the same in 2024 and maybe into next year. But that's a lot lower than it was in over the past 20 years. It's not a bad number. I mean, I think sitting here in London, I wish we could print a 5% number.
Yeah, quite, yeah.
But obviously it's higher than the average global growth. But it's still got this tale of two cities, where the new economy sectors really are booming, and the old economy sectors are struggling. Now, you know how this thing works. The new economy is the future. The old economy is the past. So my guess is it's going to go like this. We're going to have the new economy growing. China's going to be okay. But they've got some pain to take first.
Yeah, I mean, Donald Trump, if he's elected again, is talking about tariffs of at least 60% on Chinese exports. How concerned would you be at that?
Well, as an American consumer, I'd be extremely concerned. Since China is the biggest exporter of manufactured goods in the world, the idea that all of a sudden the price of my goods, intermediate and finished, is going to go up by 60% is frankly unimaginable from the perspective of a U.S. consumer. So I suspect it's not going to happen. But what I guess he's really saying is, we're going to get tough on China. Well, you ought to take a look on the guy that's sitting in 1600 Pennsylvania Avenue today and see that guy's pretty tough on China. In fact, tougher than the last guy ever was. So, look, we know the state of play. The U.S. and China are in a period of intense competition. It's probably going to last a very long time, maybe the rest of my life. It hasn't interrupted our business. It has, in fact, our business is booming in China. Right? We've doubled our profits just about in 2 years, a year ahead of our target. But is it going to get worse? Yeah, probably. Is the world going to accommodate and manage around that? Yeah, just the way we have. And by the way, Chinese companies are doing okay as well against that backdrop.
Now, India accounts for 7% of revenues just now. Would you like to see that contributing a bigger part of the mix?
Absolutely. India is an extremely important market for us. The first branch for Standard Chartered Bank was in Calcutta 170 years ago. So it's in many ways our home. A third of our employee population is sitting there. India is booming. I was in India for a week ago. The economic environment is great. The reform environment is strong. Obviously, they're going into their own elections, but the rhetoric is all about how to extend that growth. I'm very encouraged by what we see there and encouraged by our business on the ground.
Now, you've made some fairly strident remarks about the share price today. I think crap was the word you used.
I know. I know I'm going to get a note from my mother on that one.
Why do you think the market undervalues?
We ask ourselves that question a lot because, of course, when you're sitting inside a company and you're very, very optimistic that you can deliver on your plans and you're producing results which suggest that we, in fact, are delivering on our plans, and you see a share price which hasn't moved or actually moved down up until today, you say, what are we missing? And what we reflected, and we reflect regularly, is the market probably has a hard time understanding us. We're a wholesale bank and a retail bank. We operate in a bunch of different markets. Our real differentiating advantage is that we're a network bank. We connect markets to each other. It's somewhat unique in that regard. And so we have to make it easier to understand our bank. Second issue is that coming from a time not just a few years ago when our cost was the same as our income, that's a cost-income ratio of 100%, we're down to 63% today. And with the guidance that we've refreshed this morning, that will go below 60% in the next couple of years. But the markets think, you're still too expensive. So we put a very focused transformation program on the table today. We call it Fit for Growth, and it is transformation. It's not. We've cut the fat a long time ago, but we haven't completed the transformation of our business to a lean, mean digital machine. That's what we're doing now. It means significant investment in technology, which we also flagged today, and there's a cost to achieve those expense savings. But the cost is one time. The expense savings are ad infinitum. So I think we'll address the complexity challenge, we'll address the cost challenge, much as we have in the past years, but we need to take it to the next level. That's what we announced today.
Okay, Bill, got to leave it there. Great to have you in the studio today. Thanks very much indeed.
Thanks for having me.
Well, last night's gains on Wall Street, during which Nvidia's stock market value rose by $277 billion in a single session, was followed by a largely positive session in the Asia-Pacific region overnight. Chinese stocks closed up for a 9th consecutive session, while the Nikkei in Tokyo hit a record high for a second day running. Well, in Europe, stocks are going into the weekend on a largely positive note just now. Talking points this morning include Allianz. The German insurance giant is down 3% in Frankfurt after its full-year results slightly missed forecasts. Well, here in London, the FTSE 100 also going into the weekend. Well, that's more or less unchanged right now. Standard Chartered, the leading gainer in percentage terms just now, while BAE Systems remains wanted after its results earlier in the week. To the downside, International Airlines Group is off 1.5% as Brussels prepares to outline its objections to the British Airways owners' intended takeover of Air Europa. Look at Standard Chartered now up 9.5%. That'll send Bill off with a spring in his step. Outside the FTSE 100, Hornby has surged by 38% after Mike Ashley's Frasers Group raised its stake in the model railway maker to 8.9%. Lower down the corporate food chain, the miner Ironveld is up 11% on news it's received financing to invest in new operations. On the foreign exchange markets, the dollar is on its first track for its first weekly fall so far in 2024. Sterling up by 1/6 of 1% or so against the greenback. It's also up by 1/10 of 1% or so against the euro. Single currency more or less unchanged just now against the dollar. The oil price, meanwhile, has stumbled on growing signs. The US Federal Reserve is in no rush to cut interest rates. Barrel of Brent crude currently changing hands at $82.43 a barrel. That's off nearly 1.5% on the session. Well, joining me this morning is Sophie-Lund Yates, of course, the lead equity analyst at Hargreaves, Lansdown. Sophie, good to see you this morning. Got to start with Wall Street really last night. I mean, an incredible session for Nvidia. Just how much longer can this roll continue?
Hi, Ian. Well, that is the question, isn't it? I mean, we are certainly, in my opinion, encroaching on quite frothy territory. But within that, you were talking about Nvidia just there. A lot of this excitement is warranted. This AI boom, if we can even call it that, I don't think that's quite a big enough word. Demand is expected to far outpace supply for the hardware needed to sustain these technological shifts. And that should help support Nvidia in particular. But that said, and I've talked about it before, I do think there's a little bit of a disconnect happening between what the Federal Reserve is going to do with interest rates and what the market is hoping that they'll do. I don't think that those interest rate cuts are potentially going to be coming through as thick and fast as maybe the market is priced in. So a lot of excitement is warranted, but I would say a little bit of caution is needed because this bubble can't last forever.
Yeah. Now, we've been talking just now to Bill Winters. I mean, great day for Standard Chartered shares, although it's been a pretty miserable few years. What did you make of the numbers?
Yes, absolutely. A great share price move for them. The numbers really were quite robust when you look kind of underneath the hood a little bit. In particular, for me, what's really quite stark, and it mirrors what we've heard from a lot of the listed banks, is the fact that those impairment charges, so that money put aside in expectation of people defaulting on their loans, that's dropped to about 60 million compared to over $200 million. So that movement is huge, and that tells me there's a lot of underlying resilience in both consumers and economies more broadly. And of course, the fundamental thing that sets Standard Chartered apart is still very much intact, and that's the fact that they have a lot of other income streams. So that's businesses that generate fees, for example, and that to me, that diversification still means that they're pretty robust in my opinion, and that valuation doesn't necessarily reflect it at the moment either.
Okay. What are your main takeaways from this week? I mean, Lloyd's good, Standard Chartered obviously good, Barclays went down well, HSBC and NatWest probably less so.
Yes, absolutely. So it's been a very bank-heavy week for sure. And obviously, when we look at this, you've got to look at it through the lens of it being kind of an economic bellwether. Lloyd's in particular, because it is very much your kind of bread and butter banking. So their main takeaways tell us a great deal about the strength of the consumer. And again, we've seen impairments more broadly looking a lot better than feared. We've seen a lot of money is being funneled back towards shareholders, which is what's keeping the market quite happy. A lot of UK investors love finance. But what I would just kind of focus on is the fact that valuation-wise, a lot of UK listed banks are incredibly unloved. And I don't actually necessarily think that that's particularly warranted, because I do think that a lot of the fundamental drivers here, the banks and the balance sheets, look at those capital ratios. They are incredibly strong, and they don't look to be being messed with in any way. And that's really important.
Absolutely. Sophie, got to leave it there, I'm afraid. Good to see you as ever. Thank you. Still to come here on Business Live, we'll be taking a closer look at mergers and acquisitions with Erik Hirsch of the private investment firm Hamilton Lane. Don't go away.
I'd logged in and it was, I'd seen there was a win. Didn't look at the date, I just looked at it and there was a £2.60 win there. So I said to Debbie, we've won £2.60. She said, great, let's go and have a bacon butty or something, celebrate. And then later on in the day, another email arrived, exactly the same message. I thought, there's a glitch. And so I logged in again and there's a message there saying you've won £61,708,231 and call this number. And that's how we found out. And then we had, tried to ring and had problems with the phone signal and so on and so on,
Well, there are three bits of advice that we give them initially. The first one doesn't really apply to Debbie and Richard, and that is maintain your anonymity, at least until you've taken professional advice. The second piece of advice is to really just pause and reflect and put the money in a safe place on deposit. And the third thing that's really important is to take professional advice from somebody who's suitably qualified. And in fact, most of the pitfalls seem to emanate from not doing those three things.
OK, well, they haven't done the first thing, have they? They've gone public. Why do people go public?
I can see the benefits in it, because if somebody's won 61 million, then obviously their lifestyle is going to visibly change. So, there is an argument to actually go public and manage it in a better way. But the general principle is that, I mean, there are lots of JAPA winners that don't go public. You know, they maintain their anonymity. I mean, our typical advice is to, you know, maintain your anonymity at least until that initial euphoria has died down and you've had the opportunity to reflect and take professional advice.
I just took a shower above the clouds. You know why? Because this is the Emirates A380. Fly Emirates, fly better.
Welcome back. Now, after a quiet 2023, there are signs that mergers and acquisitions activity is set to revive this year. This week alone has seen a $35 billion merger in the US banking sector and two potential bidders emerging for Currys, the UK's largest electrical goods retailer. One of the drivers for that is the vast amount of money that private equity firms have available to put to work. Well, joining me now to talk about this is Erik Hirsch, co-chief executive of Hamilton Lane, a leading private markets investment firm with $902 billion worth of assets under management or supervision. Erik, welcome to you. I mean, you think there are far more opportunities in private markets than public ones. Why?
Well, the market's just simply much bigger. So there is A, no shortage of capital, and B, no shortage of companies. And so I think really what you're seeing is just a time for the markets to stabilize and agree this is the new normal. And then I think you're going to see activity pick up.
One of the interesting things about private markets over the last few years, hold periods have lengthened for private equity firms. Why do you think that is?
Well, I think this is about adding value. You're not getting things at a bargain basement price these days. And so if you're still trying to achieve sort of superior returns over the public markets, it's going to take time to actually go in there and add value and figure out growth initiatives and figure out better ways to sort of price structure. So that all just takes time. So today, about 5 years is the average hold period.
One thing I'm hearing a lot of, though, is that valuation expectations between buyers and sellers are coming closer together. Is that your view?
It is. I think this is sort of that new normal. I think when you've gone through sort of periods of extreme volatility, as we have for the last few years, I think it's hard to agree on, is this the new normal? And I think right now, buyers are sort of settling into this is where we are. Sellers are settling into this is where we are. And I think you're beginning to see transactions occur more regularly.
Are there certain types of private equity-backed companies that are going to find it easier to get an exit than others?
I don't think so. I think actually there's so much capital in the system today. And frankly, despite rising rates, there's so much money being raised in private credit that financing transactions is also relatively easy. So capital is not a problem on either the equity side or the leverage side. And so I think you're going to see activity across a lot of different sectors.
More broadly, this is an election year in the United States.
So I'm told.
Trump or Biden, what's the more market-friendly outcome?
Well, I think normally you would say Republican would be a more market-friendly, tends to sort of less regulation, tends to be more of a tax cutting. I think in these two situations, I'm not sure that's so easy to say. Trump is sort of proposing things that sort of would appear to be quite volatile for the public markets. And so I don't think as we sit here today, either of them sort of sound terrific to the markets.
We also have an election in this country. Now, the Labour Party, which looks likely to win, are threatening to tax carried interest, which is the profits made by private equity partners, as income rather than a capital gain. What would that do for the UK private equity sector?
Absolutely nothing. They still are quite lucrative, and so I don't think anyone's going to leave this sector because their tax rates go a little higher.
Wow, that's not what they're saying.
I'm sure it's not. I'm sure those that have it do not want to see that taxed. But I think the reality is, one, this has been discussed both in the US, the UK, and other markets for quite some time. And the reality is that people get paid quite well in this industry for achieving really good returns. And so whether that tax rate is sort of ordinary income or capital gains, I don't think that's going to drive talent in or out of the market segment.
What about the role of sovereign wealth funds right now? A lot of the Middle Eastern buyers are wading with big sums. Is that making it harder for private capital?
I think they're sort of putting money into the system. They're mostly funding fund managers. Don't see a lot of the sovereigns as direct competitors to fund managers, more as participants in sort of the private market ecosystem. Yes, they are flush with capital. They're putting a lot of that into the private markets. They, like others, are realizing private market performance has been much better than public market performance. And so I think you're going to see that wave of capital continue to flow.
You don't worry about it bidding up prices?
No, I think we've always had this sort of question of, is there too much money in the system? And if you look at sort of returns over long periods of time, 10, 15, 20 years, that outperformance against the public markets has been consistent regardless of how much capital has been raised.
OK, Eric, got to leave it there. Great
Pleasure.
to see you this morning. Thank you. That's it from me. I will be back at 4:30 this afternoon with our afternoon edition. Hope very much to see you then. In the meantime, thanks very much for joining me this morning. See you later. Cheerio.